daily or intraday trader typically trades multiple times a day and will be fighting against friction costs or brokers' commissions and slippage. So his system needs to be able to make more than those friction costs to provide you any outgoing profit to be available before, for compounding. So can you comment on that?
Yeah, I mean, one of the interesting things I think that's happened over certainly the past 20 years, and maybe even the last 10 years, is the fact that those friction costs have come down to some extent. And if you think, going back to the earlier days of spread betting, most of it was on stock indices. There was a fair amount on currencies, but proportionately it wasn't a very big proportion of the trade being done. And I think one of the reasons for that is that FX is attractive for day traders, but the spreads, so the friction, if you like, on trading FX in those days was, it was huge. I seem to remember spreads on cable, for instance, of being 6 ticks wide. Now how on earth do you day trade that? You just don't. Your friction costs are too big. But those costs have come down, and I think now, really, even in the retail market, you can trade, at very, very attractive rates. Sometimes if you're lucky, you can match what the institutionals are trading at. Other times it's not a long way away from there. So I would say those friction costs have reduced. That makes day trading, intraday trading more attractive, but you always have to be aware that those costs are there.
Okay. The intraday time frame is one of the most difficult time frames to trade and is as an indie, as it's where the most competition is. You have banks, matchmakers, brokerages, not to mention the proliferation of algorithmic bots all trying to find an edge at the second or microsecond. So there's very little time to have for the click trader.
Well, yeah, the competition is out there, but remember that competition is helpful in some ways because competition provides liquidity. And if you do have that liquidity coming into the market, then you have more opportunities. And now, I know, it's going to be a rare thing that everyone is on the same side of the trade at the same time or looking to do the same thing at the same time. However, you do see that. I just think it was only the other week that we saw a massive move in the dollar yen, where the dollar just disappeared. The bids just disappeared. Now, this was in the normal trading day. The US was open, Europe was open, all the market, that's the main busiest time of the day, and yet the bids just disappeared, and dollar yen just crashed. I think it lost about, the best part of 1 yen in the space of 20 minutes or so. So my point about that is that yes, you've got all these other players in the market, and in fact, the worrying thing is that the liquidity should be there, but sometimes it does disappear. And I think it's been noticeable in the stock markets in particular. We've had sort of what we call flash crashes that have occurred. And if you try and drill down and find out what's been going on and causing those flash crashes, it seems that the official explanation is that it tends to be blamed on a particular trading house for sort of putting in automated orders into the markets, which by accident, fat finger, all this kind of stuff. The actual truth of the matter seems to be a little bit more nuanced. And you can't help wondering that actually with all the automated trading that's going on, we are setting ourselves up to possibilities of big dangerous moves. So actually, I know I've kind of turned that round a bit, but I'm just sort of thinking about how you're asking me a question about sort of all these things that are going into the market now, which should be providing that extra liquidity, which should mean that we get those sort of nice little variations within the day. The intraday traders should be able to sort of pick up on this and sort of make a few ticks here and there. On the same side, we are seeing more of these sort of big, sudden, violent movements apparently for no reason, or with just a very sort of slight trigger. So it's interesting, but you've got to be a bit careful out there as a day trader.
Do you think that these, these sort of seismic shifts, which really shouldn't happen, are just a sort of endemic nervousness about what might be around the corner?
Well, that's interesting. Yes, I think there is a nervousness out there. But then again, if you look at something like the volatility, VIX, which measures volatility on the S&P 500, if you look at equity volatility in the equities market, when you consider all the issues that we have in the world at the moment, when you consider sort of like the hostilities that are going on worldwide, and you know they're widespread, the risk of terrorism, the risks of, from Ebola, the fact that we have had this very strong market move. You know, we've really been on a tear since 2009 in terms of the stock markets, with very, very small corrections when they have occurred. You know, it's like the stability breeds instability, and you would imagine, though, that sort of there would be people sort of preparing themselves for some kind of dramatic market movement, or you know, at least sort of looking to protect themselves should that happen, and that isn't really happening. You know, there's a sort of we seem sort of, the market as a whole seems very sort of calm and collected, and I almost wonder whether, you know, sort of there's this sort of smoothing effect that's happening in the markets, that the sort of like the kind of ebb and flow, the kind of sort of big jagged market movements don't occur as often as one would expect when you've got a sort of a period we've had this long period of stability, and you'd think that now we you know, people are getting more nervous. So what I'm trying to say is that, you know, again, going back sort of 10, 15 years ago, certainly 20 years ago, by this stage in sort of like the cycle, and by this stage of looking at what's happened to markets, I would have expected more volatility. But when you do see a spike in a currency, it sort of seems to come from nowhere. So in other words, you know, you haven't got that increased volatility going into the situation, which then brings about a sharp price movement. Now you suddenly seem to have low volatility, and suddenly, out of nowhere, you get this sort of spike in prices. And I can't help thinking that an awful lot of this is to do with the kind of automated trading that is going on now.